Imagine waking up on the first day of your retirement. You finally have time to breathe. You make a coffee. You sit on the porch. For the first time in years, you are not rushing anywhere. You feel free. Then the mail comes, and right there, in that pile of envelopes, you see a tax bill from the IRS. The number on it dwarfs anything you ever paid while you were working. Your heart sinks, and you think to yourself, I thought I planned for this. If that scene hits a little too close to home, I want you to stay right here. Because today I am walking you through 5 tax traps the IRS springs the day you retire. These are traps that catch almost everyone, and nobody talks about them until it is too late. That is exactly why I made this video, so you can spot the traps before they spring on you. I want to tell you about a man named Bob. Bob worked the same factory job for 34 years. He saved in his 401k. He did everything right. When he retired at 65, Bob figured his tax bill would be smaller. He was already living on less, so why would he pay more in taxes? But that very first January, Bob owed over $4,000 in federal taxes alone. He had no idea why, and he almost had to drain his savings just to pay it. Most retirees tell me the same story. They were surprised by their first tax bill. They did not see it coming. They did not plan for it. That is the norm, not the exception. People do the right things. They save for decades. They pay off the house. They build the nest egg. And then April comes, and the math just does not work. The reason is simple. Retirement income works nothing like a paycheck. And that is what I want to fix for you today. If this is making sense to you so far, do me a quick favor right now. Hit that subscribe button and turn on the bell notification. Every week, I break down another piece of the retirement puzzle so you can keep more of your money where it belongs. Trap number 1 is the one that shocks almost every new retiree. It is called Social Security taxation, and it is one of the biggest financial surprises in American retirement today. You have probably heard someone say that Social Security is tax-free. It is not. Let me say that again. Social Security income can be taxed by the federal government, and in some states, the state can tax it too. The amount that gets taxed depends on something called combined income. That is your other income plus half of your Social Security check. Here is how the trap works. While you were working, your wages filled up the lower tax brackets. You started at 0 and climbed up the ladder. But in retirement, you are pulling money from different sources at the same time. You might have a pension. You might have 401k withdrawals. You might have dividends. And right on top of all of that, your Social Security check lands. And once your combined income crosses a certain line, up to 85% of your Social Security becomes taxable, just like a paycheck. For 2026, those lines are set at $25,000 for single filers and $32,000 for married couples filing together. Cross that line and the IRS treats your Social Security like ordinary income. That is the trap. Most retirees never see it coming, and here is what they never tell you. The way you pull money from your retirement accounts can make this problem much worse. Take a big lump sum from your IRA in your first year of retirement, and you can push yourself deep into the Social Security tax zone. That is exactly what happened to Bob. He took $30,000 out of his 401k in January to fix his roof. By April, his combined income was so high that 85% of his Social Security was now taxable. He owed money he never planned for. That money had to come out of his savings. The IRS treats Social Security this way because the program was never meant to be your only income. It was always designed to sit on top of other income. And once you have other income, the IRS wants a share of your Social Security too. That is how the system works. If this information is clicking for you, I want you to do one thing real quick. Hit the like button. It takes 2 seconds, and it helps more people like you find this video when they need it most. Trap number 2 is called required minimum distributions. Most people just call them RMDs, and this trap can hit you with a penalty of 25% if you miss it. 25% on the amount you forgot to take out. That is real money. Here is the basic idea. The IRS lets you save money in your 401k and your traditional IRA without paying taxes on it year after year. But you cannot leave that money in there forever. The government wants its cut at some point, so they force you to start pulling money out once you reach a certain age. As of 2026, that age is 73 for most people. It will go up to 75 in 2033 under the current law, and the amount you must pull out is based on your account balance and your life expectancy. The IRS publishes a table every year with the percentages that apply at every age. Let me explain it simple. Imagine your traditional IRA is worth $500,000, and the IRS table says you should take out 4% this year. That means you have to pull out $20,000, even if you do not need it. Even if you just leave it in a checking account, you must take it out, or you pay the penalty. And here is the trap that catches most people. If you forget to take that money out, or you take out too little, the IRS slaps you with a 25% penalty on the amount you missed. 5 years ago, it was 50%. They dropped it to 25% to be nicer, but 25% is still a gut punch. New rules say if you fix the mistake within 2 years, the penalty drops to 10%, but you still have to file the right paperwork. And most people do not know that. This rule was created so people would not just let their retirement accounts grow forever and never pay taxes on that growth. The government wants its share. And once you hit 73 or 75, it wants that share right away. I want to hear from you. Drop a comment below and tell me, have you ever faced one of these situations? Your story might help someone else who is going through the same thing right now. Trap number 3 hits you in a place you may not expect. It is your Medicare premium, and the trap has a name most retirees have never heard of. It is called IRMAA. That stands for Income-Related Monthly Adjustment Amount. Let me set the scene. Most people think Medicare is pretty close to free. You pay a small premium each month for Part B. For 2026, that standard Part B premium sits near $185 a month for most people. But if your income is too high, you get hit with the IRMAA surcharge. And this surcharge can push your Medicare premium up by hundreds of dollars a month. Some people pay over $600 a month for the same coverage they thought would cost them $185. And here is what makes this trap so mean. The IRS looks back 2 full years to decide if you owe this surcharge. So your Medicare premium in 2026 gets set by the income you had in 2024. That is right. Your retirement year income can spike your Medicare premium 2 full years later, and there is almost nothing you can do about it once it has happened. Let me tell you about Linda. Linda retired in 2024. She took a big lump sum from her 401k that year to pay off her house. Smart move on the surface. She felt proud. Then in 2026, she opened her mail and saw her Medicare premium had jumped from $185 a month to over $500 a month. She could not understand why. Nobody warned her. She had walked straight into the IRMAA trap. This trap exists so that higher income retirees pay more for Medicare. That is the idea behind it. But in practice, it catches regular people who just had a one-time spike in income. A pension payout, a home sale, a Roth conversion done wrong. One bad year can lock you into higher Medicare premiums for 2 full years. And it gets worse. If your income is high enough, the same trap hits your Medicare Part D drug plan premium, so you pay more for your doctor coverage and your drug coverage at the same time. Can I ask you something? Have you been paying any of these bills without realizing you did not have to? I want to know because your experience is going to help someone else in the comments section right now. Trap number 4 is the capital gains trap, and this one hits retirees who own investments outside of their retirement accounts. Think brokerage accounts. Think stocks you bought decades ago. Think mutual funds that have grown over the years. Say you have a brokerage account with $200,000 in it. You bought some stocks or mutual funds over the years. They grew. Now you retire, and you need to start selling some of those assets to create income. Every time you sell something for more than you paid for it, you owe capital gains tax. And the rate you pay depends on how long you held the investment and how much total income you have. For 2026, if you are single and your income stays below about $48,000 a year, you pay zero in long-term capital gains tax. That is right, zero. But once you cross that line, you start paying 15%. And if your income gets high enough, the rate jumps to 20%. On top of that, you may owe an extra 3.8% for something called the net investment income tax. That is on top of everything else. Here is the trap. Most retirees do not plan their asset sales. They just sell when they need money. And that is when the trap springs. A few bad sales in 1 year can push you into the 20% bracket. And once you are there, you cannot undo it for that year. The good news is there are moves you can make. You can spread your sales across multiple years. You can harvest losses to offset gains. You can use something called tax loss harvesting. And you can time your asset sales so you stay just below the higher tax brackets. This is what smart retirees do. They do not sell big chunks in a single year. They plan ahead and they talk to a tax advisor before any big move. If you found this helpful, make sure you subscribe, because next week we are going to dive even deeper into another strategy that can protect your retirement savings. Trap number 5 is the state tax trap, and this one is sneaky. You spend your whole working life in one state. You retire, you sell the big house, you move to a place with no state income tax like Florida or Texas. You think you are home free, but that move can trigger a tax bill you did not see coming. Here is why. Your retirement income is not a single thing. It is Social Security. It is a pension. It is a 401k. It is IRA withdrawals. And each one of those has its own rules depending on where you live. Some states tax Social Security. Some states do not. Some states tax pensions fully. Some states tax only part of it. And some states tax IRA withdrawals at the same rate as wages. Let me give you an example. Say you spent 30 years working in Illinois. You retire. You move to Florida. You figure you will pay zero state tax on your retirement income. And for most of your money, you are right. Florida does not have a state income tax on individuals. But here is the problem. If you take a lump sum from your 401k right before you move, Illinois can still tax you on that money because you earned it while you were still an Illinois resident. This is what happened to Frank. Frank worked in New York for 35 years. He retired at 62. He moved to Tennessee the day after his last paycheck. He thought he was done with state taxes forever. But New York sent him a tax bill the next spring. They said he owed tax on his final 401k distribution, almost $9,000, and Tennessee could not help him. Tennessee did not tax that money at all, but New York did, because Frank earned it as a New York resident. So what do? You plan your move carefully. You pull income from your retirement accounts after you become a resident of your new state. You do not take any large distributions in your final year of work in your old state. You give the new state time to claim you as a resident, and you check the rules of both states before you make the move. The IRS knows people try to dodge state taxes by moving. So they have a rule called the 183-day test. If you spend 183 days or more in a new state, you become a resident for tax purposes. So timing matters. Day counts matter. Where you vote, where you register your car, where your doctor is. All of that matters when the new state files a residency claim. If you know someone who needs to hear this today, do me a favor and share this video with them. It might be the most helpful thing you do for them all week. Now let me pull all of this together and show you what a smart retirement looks like in real life. I want to walk you through a complete example so you can see how all 5 tax traps show up at the same time in one single life. Meet Maria. Maria is 64. She lives in Ohio. She has a 401k worth $800,000. She has a small pension from the state. She has $50,000 in a brokerage account. She is getting ready to retire in July. If Maria does nothing, here is what will happen. In her first year, Maria plans to take $40,000 from her 401k. She will start collecting Social Security at 65. She will also pull $15,000 a year from her brokerage account to fill in the gap. Her total income will be over $55,000 a year. And because her combined income will be that high, 85% of her Social Security will become taxable. That is trap number one. Trap number two shows up at age 73. Maria will have to start required minimum distributions. The IRS table will force her to take out a chunk each year, even if she does not need it. If she forgets or takes too little, she will owe a 25% penalty. That could easily be $5,000 or more in a single year. Trap number three hits her Medicare. Because Maria's income in her first two retirement years is high, her Medicare Part B premium in 2027 and 2028 will include the IRMAA surcharge. She could pay $400 a month or more for Medicare. That is $4,800 a year she did not plan for. 2 years of higher premiums because of one good year of retirement income. Trap number four is her brokerage account. If Maria sells all $50,000 in 1 year, she could owe capital gains tax on the growth. Depending on what she paid for those investments, that could be $5,000 or more in 1 year. And trap number five only shows up if she moves. But if Maria plans to stay in Ohio, she is on the hook for Ohio state income tax on her retirement income too. Ohio taxes traditional IRA withdrawals, so she owes Ohio its share as well. Right now, Maria owes money to 4 different tax collectors every single year: the federal government, the state of Ohio, the Medicare system, and she is paying a capital gains hit on her investments. That is not what she's signed up for. That is not the retirement she imagined, and that is the trap. Before we wrap up, if you have not already, please hit subscribe. I have so much more to share with you, and I do not want you to miss a single video. So what should Maria do? Let me give her a clear plan. And this is the same plan you can follow starting today. Step 1. Maria delays her Social Security until age 70 if she can. Every year she waits, her check goes up by 8%. That is a guaranteed raise from the federal government, and it lowers the amount of her other income that gets taxed as Social Security. She wins twice with one move. Step 2. Maria plans her 401k withdrawals carefully. She does not take a big lump sum in her first year. She pulls only what she needs each year, and she keeps her income just below the IRMAA threshold, so her Medicare premium stays low for the next 2 years. Step 3. Maria sets up qualified charitable distributions once she turns 70 and a half. QCDs let her send money directly from her IRA to a charity she cares about. She never touches the money. It counts as her required minimum distribution, and she does not owe federal tax on it. For 2026, that limit sits at $108,000 per person per year, indexed for inflation each year. Step 4. Maria sells her brokerage investments in chunks. She does not liquidate everything in 1 year. She spreads the sales across 3 or 4 years. She keeps her income just under the 15% capital gains bracket. And she uses tax loss harvesting along the way to bring her tax bill down even more. Step 5. Maria talks to a tax advisor about Roth conversions in her lower income years. She can move money from her traditional IRA into a Roth IRA. She pays taxes now at a lower rate. Then all future growth comes out tax-free in retirement. There is no required minimum distribution on a Roth IRA during the original owner's lifetime. That gives her more control over her tax bracket every year she is retired. Now let me leave you with the 3 most important takeaways from this video. Number 1, Social Security is not tax-free. Plan your other income carefully so you do not push yourself into the Social Security tax trap on the day you retire. Number 2, Required minimum distributions start at age 73, and the penalty for missing them is 25% of what you should have taken out. Set up automatic reminders. Pull out only what the IRS table tells you to pull out. Number 3. IRMAA can spike your Medicare premium by hundreds of dollars a month for 2 full years. Control your income in the first 2 years of retirement, and you can sidestep this trap completely. You hold the power here. The IRS sets the rules, but you get to decide how to play the game. Now you know what the traps look like. Now you know how to sidestep them. So go out there, talk to a tax advisor, set up your withdrawals, and refuse to pay a single dollar in taxes that the rules do not require you to pay. If this video helped you today, please make sure to subscribe and hit that like button. Share it with someone who needs to hear it. Leave me a comment below and tell me which one of these 5 tax traps surprised you the most. I read every single comment, and I love hearing from you. And if you found real value in this video, share it with a friend who needs this information before they retire. Next week, we are going to cover the 7 bills that seniors are legally exempt from paying. You will not want to miss that one. Until next time, keep retiring smart.